Thus, the 6.4. XYZ Limited is presently all equity finance. So this is unlevered firm. The director of the company has been evaluating investment in a project which will require 270 lakhs capital expenditure on new machinery. They expect the capital investment to provide annual cash flow of rupees 42 lakhs indefinitely, which is net of all taxes adjustments. The discount rate which it applies to such investment decisions is 14% net. So this might be also its KE. Why? This firm is 100% equity financed. So what will be their cost of capital is nothing but only KE. So this might be their KE, that is 14%. The director of the company believes that the current capital structure fails to take advantage of tax benefit on debt. This is correct. When you pay the dividend, it is not tax deductible, but when you pay the interest, it is tax deductible. And the proposed of finance a new project with undated perpetual debt secured on the company's asset, the company intends to issue sufficient debt to cover the cost of capital expenditure and the after-tax cost of issue. The current amount gross rate of interest required by the market corporate undated debt of similar risk is 10%. The after-tax cost of issue are expected to be 10 lakhs. So this is after tax. If you want to issue your debt, you will have to incur expenditure of 10 lakhs rupees post tax. So everything, tax benefit, tax paid, everything is considered in. Tax rate of the company is 30%. You are required to calculate the adjusted present value of the investment. First, let me find out present value of the investment. Please understand, if the company still goes with all equity, what is the benefit they get? 42 lakhs for infinite period of time post tax, which is net of all tax adjustment. So what will be present value of cash inflow? 42 lakhs every year, discounted at 14%, present value of infinite cash flow without growth. It is nothing but cash flow of first year divided by rate of interest. This will become my present value of cash inflow, which is 42 lakhs divided by 14%. Which is 300 lakhs, minus present value of cash outflow. What is my investment? 270 lakhs plus 30 lakhs is nothing but net present value. If this firm continues to be all equity financed, then this will be the scenario. The NPV of this project, if everything is financed through equity, will be positive 30 lakhs. If it is positive 30 lakhs, company should go with this proposal. But if the company goes for all debt, please understand, the company is still going to earn a cash flow of 300 lakhs and still there will be a capital expenditure of 270 lakhs. So instead of taking both the figures, I am taking NPV if it is all equity financed. NPV is positive 30. Now please understand, if I convert this project from all equity to all debt, what are the benefits? What are the losses? Let me adjust it over here. This is all equity. Number one benefit is whatever interest I will pay. Now, interest should never be considered as far as the proposal of capital budgeting is concerned. Why? Interest is not considered in cash flow. Interest is considered in discount rate. You always take EBIT minus taxes. You will never take EBIT minus interest minus taxes as your cash flow as far as capital budgeting decisions are concerned. Very simple, because if you deduct interest and then you again discount your cash flow, you are considering interest for 2 times. So the interest is not affected, but the tax benefit on interest will be my benefit. That I should consider, and that will increase my NPV to an extent. What interest I am going to pay every year for a perpetual period of time is 10%. How much money I am going to borrow? 270 lakhs. Borrowings will be 270 lakhs? No. Why? I will have to incur this expenditure 10 lakhs. I need 270 lakhs. So I will borrow 280 lakhs, pay 10 lakh rupees as expenditure, and I will suffice my requirement by 270 lakhs. So I will totally borrow 280 lakhs multiplied by 10% for a perpetual period of time. 28 lakhs rupees will be my interest. Multiplied by 30% is nothing but tax benefit on interest, which is 8.4. Now 8.4 lakhs is the tax benefit on interest for the first year up till infinite period of time. Here I am not talking, this all cash flows are not of year 1 or year 0 or present value. They are net present value of all the year's cash flow. So what benefit I'll be getting by this is nothing but 8.4 lakhs for infinite period of time at 14% factor. The answer is no. Why? Now I am talking about interest. Now I will be raising debt where the cost of debt is nothing but 10%. I will be discounting it by 10%, which is nothing but 84 lakhs. Alright. Please understand, we have even done Modi Giuliani Miller. And at one place, this was the answer. Debt into tax rate is nothing but total tax benefit as far as the present value is concerned. What is the total debt we are borrowing? 280 multiplied by 30%. If I do this, 280 multiplied by 30%, it is 84. It is nothing but present value of benefit of all the cash flow because of this debt. So this is plus 84. What will be loss if I issue debt? That is issue cost, which is 10 lakhs. Sir, why not 270? Why we are not considering 270? Because we have already considered it over here. We need not again consider 270. So if this is plus 84 minus 10, I will be getting answer of plus 74, that is 100 and plus 104. This is nothing but adjusted NPV. Is it beneficial for the company to issue debt? The answer is yes, because debt will create a levered benefit, leverage benefit, and ultimately all debt portion is better for the company. The adjusted net present value, adjusted discount rate. Now understand, in suggestion there are different ways by which the answer is found out. But if someone asks me what is my discount rate, see, what is my cost of equity is 14%. My cost of equity is 14%. My cost of debt is 10 into 1 minus 30. That is nothing but 7%. You need to tell me whether you are going to go for all equity, whether you are going to go for all debt, or 50% equity or 50% debt. Otherwise, I cannot give you a discount rate. If you tell me I am going to go for 100% equity, your discount rate will still remain 14%. If you are going to go for 100% debt, your discount rate is going to become 7%. If it is post-tax cash flow, if it is pre-tax cash flow, it will be 10%. If you are going to do a mixture of debt and equity, say 50-50%, then my discount rate will be 10.5%. If I am going to go for 50% equity and 50% debt, then discount rate will be nothing but 10.5%. These are adjusted discount rate. Which discount rate is to be used when 100% equity 14%, 100% debt 7%, 50% equity 50% debt 10.5%. Any mixture, I can always find out the adjusted discount rate. In your suggested answers, another method is also given to find out adjusted discount rate. I think that is not required. That is not more logical than this. And so you should skip that particular portion and give your answer in this manner. 100% equity 14%, 100% debt 7%, 50% equity 50% debt 10.5%, and in any mixture of debt and equity we can always find out KO and give discount rate for the project.